What is going on, YouTube and beyond? I hope you guys are having a good evening or morning wherever you are. And I hope you had a good weekend. This weekend has been really just flown by for me. But I wanted to give you guys some updates. Welcome into another webinar here with the Everyday Growth Advisors. And I've missed doing these, and I really hope that you guys benefit from this one as well. There is a lot of stuff to cover today. I'm gonna also be taking the time to kind of go through a little bit of the basics of options, and then after that, we're gonna dive into the nitty-gritty of unusual options activity and what you should really take away from this webinar. So I hope that you guys are buckled up. If you are ready to go, if you could put a quick thumbs up or, let's go, like Kel said, in the comments, the chat, and I would truly appreciate it. Also, make sure you hit that like button so the YouTube algorithm can get kicking and we get more people in here who actually want to learn about this stuff for real, instead of like just kind of saying that they want to learn. So I really hope that you guys will help me out there. So welcome in. Once again, it's been a long time coming. I took a big break from trading for about 2.5 months, went for a beautiful trip, just some live updates that I want to share with you guys. Went for a kick-ass festival in Lisbon, Portugal. I was in Bangkok for a little while trading and kind of working remotely. I wanted to test out if what I've been trying to build my life is actually working. In other words, whether I could do trading as a profession on the go after 10 years of doing this and kind of in the past 3 years being tied down by COVID to some degree. I wanted to also know, if those parameters would work out for myself. And it turns out that, it's very, very doable. So I had a trip in that festival, went to Chicago, went for an Alaskan cruise. It was beautiful. And then came back to Singapore shortly after, visiting my family and stuff like that. So I'm back here in Singapore now and kind of just been getting back into the flow of things. But I wanted to put out this webinar because we voted on it a while back, and when I do something, I always like to do it right. I don't believe in 6:30 work. I always believe in putting out value, and if I don't put out value, then it doesn't get put out. Simple as that, right? For those of you that know me for a long time, you know that's how I roll. So this webinar comes at a timely event when the market is kind of selling off, and I want to dive straight into it. And first of all, obviously, you should know who you're listening from, who the founder of Everyday Growth Advisors is, which is me, and why you should even listen to me, right? Why am I qualified to give you this information? And honestly, there's a lot of this information out there, but what is going to stand out from today's webinar is the amount of unique things that we're going to share together, right? Because this is kind of my 10 years of trading experience that I put together, and I have an actual master's in finance, so I do understand finance from a very deep perspective, the backbone of the economy and things like that, right? So I currently manage about a $2 million hybrid stock and options portfolio, which of only $100,000 is traded for options. The rest are mainly invested in long-term investments. For most of you that know, I don't put my capital all into my options portfolio, right? And the past 5 years has been pretty good to me so far. So I'm trying to teach people how to, manage your skill, manage your expectations in the market. But let's go through today's agenda. So today's agenda, we're going to be talking about the basics of options, the introduction of the buy versus sell side. You need to understand the risk profile on both sides of the market. And we're going to talk about that buyer versus seller mentality and how they interact with the market. Then we'll also talk about how do you track and trade unusual options activity, which is going to be pretty much an educational lesson. So we're going to do it classroom style. I want it to be interactive. I don't want this webinar to be one of those webinars where you just watch. I want all of you to get involved. I'm going to be asking multiple questions. I fully expect all of you to be present and engage with me, because the way you will learn is if you engage with the different nuances and the different scenarios that I'm going to put in front of you. And that way this becomes a great engaging session where we're all learning together, rather than you just watching from a screen some random dude talking to the internet about a subject that you might not know about, right? So we're gonna kind of get into that, and after that we have live Q&A. Now, just in case some of you don't make it to the end and you're gonna drop off at some point of time, I just do want to very quickly inform you guys that we will be having a live course that is going to be coming up. The beginner course and the technical analysis course is coming back, but it's going to be held in the end of October all the way to the mid of November. Okay, I have switched around the timings a little bit to accommodate certain schedules better, and also I'm pretty much changed the structure of the course, and it's going to come with some refreshed material now. If you're an alumni of the EGA community, you already know if you have bought beginner or technical analysis, or you bought a bundle, you can take this course at no additional cost, right? That means it's free to you, it's lifetime. Remember, once you purchase this course, it's a lifetime kind of opportunity, right? So you get to trade with me live and such. Okay, just wanted to put that out there so that you guys know, and then we can get straight into it right now. At the end, we'll have a Q&A, so if you have questions, hold your questions till the end. And we're gonna jump right straight into it because I want to keep this tight and get everything sorted out. So what are options? And I think we've spoken about this in class before multiple times. I think by now this is just a really quick breakdown. Majority of you should know what an option is. It's pretty much a contract that you can buy or sell in order to have the right to purchase shares or sell shares. Okay. And so this helps you to mitigate your portfolio risk or deliver additional returns. How do you deliver additional returns? This is something we call covered calls, right? If you guys remember what covered calls are. And when we talk about mitigating portfolio risk, this may be a synthetic short, for example, right? So there are many ways that you have to have at the back of your head, like, okay, these are all the tools I have in my tool bag, so that when the time comes, I can go in this battle, right? Now, buying options will give you the right, but not the obligation to either buy or sell the asset at a specific strike end date in the future, right? This we all know by now. You buy an options with an expiry date and, at a specific strike price, hoping to get to that strike price, right? And options can be obviously used to deliver additional returns by increasing leverage and risking less to make a fixed time period prediction. We are all looking for the best timing on the calendar day for us to hit a home run. And I know many of you know what I'm talking about. Some of us are not very satisfied with making 20% per day. Some of us really want to go for that 100, 200, 300%, right? And that's what really makes it a rewarding instrument, right? Because you can really increase leverage. And this component is a lot to do with the fact that the options contract represents 100 shares of what you're trying to buy or sell, right? So it forces the rewards into a box time frame. It's a very specific time frame. And we're going to talk about time as an intermingling kind of concept with options because it is a very important part of it, okay? Now, obviously, options are derivative products, so they are derived from the stock price, and this means that they depend on the stock price. Okay, the price of a derivative depends on the price of the stock. Therefore, the person with the real power is the holder of the underlying asset. Okay, many people make this mistake, and just after I said this, I'm going to ask you guys a question, so I hope that you guys will all reply. If you buy a options contract, but you buy 1 million contracts of a specific stock, right? Will it affect the stock price directly? I said directly for a reason, okay? And you can answer yes or no, okay? Now, in the meantime, I'm going to move into the next spot, but what do you think, yes or no? You can put your answer down in the chat. If you buy 1 million contracts, do you think it moves the stock price? But we're going to get into this part here where we're going to discuss the difference between calls and puts, right? So let's dive straight into call options. These are when you're expecting a bullish outcome, right, for the underlying. And then the buyer of the option pays a premium to secure the right to purchase that stock at said price at the specific date, right? Can you guys hear me? I hope you guys can hear me. I didn't see anyone reply. Oh, is this stream just very lagged out? Interesting. Okay, I don't know. I don't know if the stream is lagged out, but I think like I'm saying something and maybe you guys get it only after about 30 seconds, which is weird. Okay, great. Anyway, try and answer the question. So if you bought 1 million contracts of a specific options contract, is it going to directly affect the stock price? I want to know what you think. Okay, that's really important. Answer that question now. Okay, so someone said not directly. Okay, no direct effect. Okay, great. All right, more answers now is coming in with direct effect, not direct effect. Okay, very good, very good. So it's not a direct effect, but you can get yourself into something called a gamma squeeze, right? A gamma squeeze. Okay. Oh, if my fucking thing would work. So there's something called a gamma squeeze, and I think some of you might know this. And majority of you might be not sure what a gamma squeeze is, but we can obviously talk about that a little later. If somebody doesn't know what a gamma squeeze is, I want you to type in the chat right now, what is a gamma squeeze? So I can go through it and explain later when we are through with this specific portion of the class. So when you do buy a call option, right, what happens is you're waiting for your price of the underlying to go up so that your options contract can value more. And then when the options contract is valued more, you pretty much get yourself a nice tiny profit because the contracts are juiced up in terms of premium. There are a lot of people that want those contracts and they are more lucrative to buy, right? And the same goes for the put option side. And this is when you're expecting a bearish outcome for the underlying, right? And this is when the buyer pays a premium for the right to sell the stock, okay? Now, one thing that you have to definitely realize about put options is that put options are mainly used, or rather a big percentage of them are used for hedges, right? And I explain this to students all the time. Think about it this way. Just think of a company like BlackRock, right? A holding company like BlackRock that owns every freaking thing in the stock market, right? And think about how they would hedge their entire portfolio, right? They wouldn't buy and sell stocks actively because they want to stay invested in those stocks. What they do instead is to buy put options or a specific synthetic short style trade in order to get their positions hedged, right? When a downturn happens, when the market's looking like the outcome is going to be downward price action for the next 6 months or so, for example, right? Nobody's going to go and sell the stock and then buy it back at a lower price. Big companies don't do that. They use derivatives, right? And this makes up a big percentage of the open interest. Right? For those of you that didn't know this kind of stuff, I mean, I'm glad to be sharing it so that you are aware of these. So this is one of the reasons why, when you pull up a specific stocks, for example, open interest, and specifically, let's say you pull up the open interest on SPY, right? And obviously we have like a little bot that can do this on the Discord. So I want to show you. So I want to pull up the open interest on SPY here and give you an example. This is how we learn. We learn and then we apply. Learn and apply, right? This way you're not going to kind of get yourself into a pickle. I mean, you'll understand everything. So look at the open interest of this entire table here. This is the SPY open interest. What is open interest? Open interest is all the number of people who are holding options contracts on the start of the trading day. Okay, and this number gets refreshed every day at the start of the trading day, right? So you will see open interest change day over day, okay? And then you will get splits within open interest. You can look at all this data, right? So for example, for the 9/22 expiry that just passed, we had 1.4 million open interest in contracts on SPY. And then out of these, 61% were puts and 39% were calls. Right? You can see how the numbers skews. And there's 4.4 million volume traded versus the 1.4 open interest, which means, what is the multiple here? The multiple here is roughly 3 times, okay? Roughly 3 times. So 3 times more volume in this scenario. And by the way, I'm sharing this with you because this is important. We're gonna get to more analysis like this in the future. So it's good if you understand what I'm talking about here. Then you have the volume breakdown as well, which is less important, but this is more important. The multiple, 3x here. This is 3 times the open interest volume. That's an important and prominent fact. If you look at now, starting from this week, you can see these all go like daily expiries, right? So for example, the end of this week, we'll have the 29th, and the 29th here, you'll see another 1.8 million open interest, right? And 70% of these are puts and 30% are calls. So the 929 area of SPY, right? The day for SPY is going to be pretty pivotal. Now, does this automatically mean the market's going to squeeze further down? I know that's what's at the back of your head. Majority of you right now, this is what you're thinking to yourself. Say, is the market going to just continue tumbling down? You cannot answer this question just by looking at this data. Okay? You cannot answer the question. This is where traders fall into a slippery slope, and we're going to get into that in a little bit. Okay? So I just wanted to show you how this dynamic works on the the tools or the data that you look at. It's just stuff that you should be already knowing. Okay, so now we talk about the buyer and seller profile. Okay, this is a lot of this stuff I guess some of you would know, but we go through it anyway. I don't know what a gamma squeeze is, when price shoots up and down in a short period of time. Okay, we will get to what a gamma squeeze is by the end of the webinar, I guarantee it. And I'll explain to you how 1 million contracts can affect a stock directly if it is, through speculative market activity. Okay, let's just call it that way. So, on the buy side of an option, you have both calls and puts, and on the sell side of the options chain, you have also calls and puts, right? So you have pretty much two ways to interact with the market. You can either be somebody who is going to take liquidity from the market and you're going to buy time. Okay, so you're going to use your capital to buy time. Okay, and here, what are you going to do? You're going to be receiving a credit to sell time. This is one of the best ways I would go about thinking about options. Okay, you're a time buyer and seller, okay? Because time is an important component, all right? So, I thought the OI was a reflection of options contracts that were held overnight. Yeah, that's what I said. That's exactly what I said. It is all the contracts that are available at the start of the trading day. Who's holding them? How many of them are being held that have not been closed out? That's open interest. Okay, so time trader. When you buy a call option, you want the price to go up. When you buy a put option, you want the price to go down. Nobody has a problem understanding this, right? I think the part that trips people up is the sell side, right? Is where people start getting to in their head and they're like, oh, wait a minute, I don't quite understand this, right? So let's jump into the sell side. So the sell side, when you want to sell a call option, what you're actually saying is, I want the stock price to come up to this specific strike price. Let's say it's $50, right? And then we want it to not exceed $50, but we want it to hang around here or go down. That's when you sell a call option, right? We are putting a ceiling on where we think the price should go, and it should fall after that, right? And what happens in this process is, one, you collect premium, and two, you don't get assigned short 100 shares. Because when you sell a call option, who are you selling the call option to? You're selling the call option to somebody who wants to buy the call option. And the person who buys the call option, what is his right? He can buy 100 shares, right? That's his right. So if the option is in the money, he's going to buy the 100 shares from you. And the dealer will make you short 100 shares. Okay? So that's how the dynamic of this market works. And that's why you want the price to go down, or you want the price to go sideways. Because during that time when the price is going sideways, somebody tell me what is it that is acting on the options contract, and why are you receiving premium in that specific case? Does anybody know what is the word I'm looking for? It's a little Greek. It's called theta, right? Exactly, thank you. So theta is the reason why you want to be on the sell side. And now I know a lot of people that make a lot of decent money just being on this side. Just so you know, for my personal portfolio, on a monthly basis, if I'm disciplined, I could make an additional 3% just selling covered calls. Okay. Now, some months are not going to be suited for it, but a month like this one, for example, is a perfect time to be selling covered calls. Okay. And you can also be selling cash secured puts in this time. In fact, cash secured puts are even better, because what happens in a market like this is volatility goes up, right? And what does volatility mean? It means that people are paying more on both the buy side and the sell side of the option chain. Therefore, it's a good time to be an option seller now, right? Implied volatility is higher, right? So now, on the put side, this is when you want to sell a put to somebody. Who are you selling the put to? You're selling the put to somebody who is buying a put. That other person thinks that the prices are going to come down, but you are selling that contract to him, hoping that the price will either go up or sideways, right? So this is the opposite scenario now. This is where you have a stock coming down, and let's say this is the $50 strike. You don't want the stock to break. You want it to bounce, or you want it to go like this and then back up, right? So you're putting a floor on prices now. Floor. Earlier was ceiling, right? Ceiling. This is ceiling. Okay? This is how you're going to interact with the market as a buyer and a seller. Okay? And so now, based on these, there are different risk profiles. But before that, we need to discuss something important, which is the Greeks. And out of the Greeks, I'm not going to touch on all of them, because you can read this on your own. But really specifically delta, gamma, and theta, right? Because these are the three that really impact your life. And right now, Vega and Rho are also obviously taken into account because of interest rate policies that have been changing, right? So this makes options contracts even more expensive, right? When interest rates go up, what happens? Liquidity is less abundant, right? So the money supply goes down. And if money supply goes down, each dollar is worth more, right? So that's what we call a tightening, right? Tightening. So the tightening of monetary policy has led to a lot of options contracts becoming more expensive in this current time, because that dollar that you used to once have an abundant supply now is more expensive, right? But more importantly, you have delta. Now, delta is like the father of a family, okay? This is the family, the Greeks. They're called the Greeks. Like how you have the Adams family, you have the Greeks, right? And delta is the one that gives the meat and bones. In other words, the value. Really drives value in an options contract. But what it does is measures the sensitivity of the contract's price, or rather the premium, with regards to the price of the underlying. For every $1, for example, a options contract goes up, delta will move by a value between 0 to 1. Okay? And that 0 to 1 value will have other components of Vega, Theta, Gamma built in, right? To give you like a multiple, which is maybe 0.5. And this will tell us that for every $1 move, 50 cents will be added to the contract price, right? So if the stock goes up by $1, your contract goes up by 50 cents, for example. And that value is derived by the Black-Scholes model, right? Which is constantly calculated and supply and demand of the exact option. Then you have the mother, right? The mother. And this is gamma, right? And gamma here, this measures the rate of delta. So the mother is always looking at the father, or rather the wife always looking at the husband, always suspicious, right? What are you doing? Where the fuck are you going, right? Like all that kind of shit. And so this, the part of gamma, which is a very guarded piece of the Greeks, is really the reason why delta is able to perform so well, right? Because when gamma spikes, delta goes up as well, and then there's a very interesting synergy between these two Greeks, because they kind of bounce off each other, right? And they tend to go parabolic, okay? They tend to go parabolic. But luckily, gamma has a peak, and so the peak of gamma looks something like this, like a bell curve almost. And at the peak gamma, you have delta that kind of also gradually moves upwards here and front and center here. Now, because of gamma, the options contract gains a lot of traction, okay? And with theta, this is mainly a component in the Greeks that will measure time decay. So every day there's a set value, like for example, 29 cents, right, on the contract that can be decayed away. I'm giving you like a very loose example. But the theta is calculated once again as an offshoot from your gamma, delta, vega, and rho, because they're all interacting together. Okay. So now you know the Greeks. You've been introduced to the Greeks. By the way, theta is the son of the family, just so you guys know. And then vega is pretty much the daughter of the family, because this measures volatility, sensitivity to volatility. And rho is like family member that comes around for Christmas once in a while. Not really that prominent, but sometimes can say stuff that will throw you off guard, right? So now that you know a little bit more about delta, gamma, you know a little bit more about the buy side, sell side, you know a little bit about the basics of options. Now you can jump into what unusual options activity is, right? And unusual options activity is something that has come up in the past, I want to say, 5 to 10 years has really gained traction. Okay, it's a legit auto flow analysis method. And there's a really simple reason for that, okay? Unusual flow, first of all, refers to a abnormal large sum of bets using derivatives, okay? And over the time, I think as you have continued being in market since 2020, you would realize there are more derivative tools out there right now than there ever were before. There are literally indices that you can bet on outcomes and completely degen your life away. You can go and play an inverse Kramer ETF, and then you can put options against it to inverse yourself. It's really an interesting concept, but to me, the unusual options activity in the market allows you to really just hunker down and decide when smart money is going to take a good chunk of a position. Okay, and this is an example here. This is just Tesla flow over the past trading session that we had. I decided to take a screenshot of it, and you can see a whole bunch of trades here that are within a specific expiry, within a specific strike. Right? I'm guessing all of you would have at some point seen a kind of a matrix like this. This one is flow algo, but then there's also unusual whales, there's option strat, there's quant data, there's a variety of different flow services right now that give you all the information, and that's kind of the problem also, right? So I'm going to go through why or how these are important, and also kind of talk about how you kind of circumvent these and really do well with them. So we want to specifically look at the volume traded, right, of an option. The more people are trading that option, there is liquidity in that market, and we want to stay with those choices. We don't want to specifically only look at open interest or just volume or just the aggressiveness of buying and selling, but we definitely want to see the volume that is being almost 5 times higher than usual, more than the daily average, right? And then we consider it unusual, okay? And this might really, it seems straightforward, okay, I'm just going to look at the volume, and I'm also going to look at, the activity in general, how often are they hitting it, and stuff like that, right? Or maybe there's a bunch of sells, and then there's a bunch of buys, maybe they're just moving with the market. It might seem straightforward, but it really isn't. It really isn't. It takes years to master this, and there are a lot of assumptions that you can get wrong. So this is the big word for today. Today's webinar, the big word is assumptions, because the more assumptions you make in UOAs, the worse off you're going to be. So I'm going to talk about just the UOAs and what they are in this slide here as well. Just like your level 2 data that you use to analyze order flow and aggressiveness on the tape, right? We have times and sales, for example. Your UOA analysis allows traders to catch a move before it happens, because you will know that it's happening before, mainly because you will realize that when volume for a particular day is higher than the open interest, that means, think about this for a second. Let's say there are 5,000 people that hold this contract, so the open interest is 5,000 to start the day, and volume is 15,000 or 20,000, right? That means there are 4 times the number of people trading than the open interest on that day. Then some move has yet to happen, right? It has yet to happen. If it hasn't happened yet, it has yet to happen by smart money. Because something is going on there, there's a speculation, it's going either way. We don't know which way it will go for sure, but we know that it's going to go a way because there are increased amount of people trading these contracts, right? And so this is one thing about unusual options activity that allows you to survey, right? And obviously you need a deeper analysis to confirm your theory and kind of see the story that the person who's putting on that trade sees. And sometimes it boils down to understanding how institutions trade, right? You have to know the institutional playbook in order for you to start to visualize what the institution is actually doing, right? Is that fair so far? If you guys are following along so far and you are enjoying this webinar so far, I would like some feedback in the chat. Tell me, you guys. Are you following along so far? All right, chat. And if you have any questions so far, I want you to drop them in the chat as well, so that I can get to them in a little bit. I like it. I'm following. All right, great. I want to just hear from a couple people so I can confirm you guys are indeed hearing my voice. So this is these are two charts right here I put on this slide because I want to show you what unusual options activity looks like, right? For example, this is an example of Tesla's options activity in the past week. Now we get these day over day. These are obviously not easy to find. They are proprietary data that we pay a lot of money for, and I think that these are very helpful in helping you understand very quickly at the start of the day what has happened, right? So what do we look for generally? We look for the change in open interest, right? Because the change in open interest will tell us what has happened overnight, how many more people are in this market and how many people have left this market in terms of the strike and the expiry, right? So when we see open interest rise, we know more people are holding the contracts now. And usually it's very easy to kind of pick up on whether the open interest is split between puts or calls and where the market sentiment is in terms of the derivative market, right? You have all of this information. Just like how I pulled up the open interest for SPY earlier, I can pull up the same open interest for Tesla, right? For example, so we can look at it together, for example. So pulling up open interest for Tesla here, you can see a variety of different things, right? Now, just based on what I told you earlier, going back to what I told you earlier, the last week, and normally big amount of OI once again, right? 729,000. That's more than in usual or in general, right? And you can see this coming week, it's going to be 423,000, also not pretty significant, right? Most of it is skewed on the call side. So this is one of the reasons why Tesla has not been aggressively selling off yet, right? It has been kind of actually relatively strong with the market. If you guys agree, if you agree, say I agree, right? Has Tesla not been relatively strong from the market chaos that's been going on in terms of the sell-off that just happened last week? It kind of has, right? But now look at what's interesting is on the 20th of October, right? The sentiment flips, right? The sentiment flips to the other way now after this, right? It goes more put side driven on the October 20th expiries. And that's about 1 month away, right? That's 1 month away because today is September 25th, so you have about 3 weeks. So these contracts are going to decay and decay and decay as we get there. The January contracts are already seeing a significant amount of call side activity. You can see that, right? 2.1 million open interest here, and 62% of that open interest are calls, right? The volume traded, in fact, majority of volume traded within this option are puts. That means a lot of people are holding calls here, right? And the majority of the trading action is happening around puts because the volume was 63% on puts, right? Much higher. So studying this part of the unusual criteria of the options gives you a better idea of where the stock is potentially hitting in the short term and the long term. It's not only important for you to see what's happening just in this next week. It's important for you to build a story as you go further down and ask yourself, why might this happen? Start building those scenarios. in your head. And obviously for SPY, it's a little more different. I wouldn't, try to do it on SPY because it's just too liquid. It has a lot of activity, and majority of it can be skewed because it's hedges, right? So now, once you see that, the open interest is split between call put side, how much of it was a split, blah, 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 and you get all that information. Now you look at this is the unusual part of it, right? This is the table change day over day for the open interest. And you can see the majority of open interest changed on Friday was your 929 contracts for this week expiry. And most of it was the call side, 277.50 calls that were bought at the ask. You can see that it was either bought at the mid, or the ask, right? If something comes up as the bid price, what does that mean? That means that is a seller, right? So for example, this week, look, they took some profits on their Tesla 345s, which were bid side. These were sold contracts. They have reduced the open interest in those two, right? Because they had sold those contracts and now they're buying back, right? The same thing happens here with the 285 calls. This is now on the bid side. So you can see somebody is selling some calls around here. And even though it's a plus open interest, they could have bought back this position. This could be happening after the fact, right? So maybe this is somebody closing out a position that they were holding before on the bid side. And so understanding where you are on that buyer and seller, part of this is a really important part. And really analyzing it is an important part as well. So you learn all these things as you go along, right? It's the reason why I put together this webinar so you guys understand. And then you have I get one of these per day as well. This is unusual volume in general, right? And really here, what you're trying, like majority of these are going to be garbage. Like you're not going to trade all of this bullshit, right? All this, blah, 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 blah. But then you have something like Jets or NVAX or DocuSign, right? And then Moderna, Pfizer, IBM, right, for example. And what you're looking for here is a multiple of like more than 3.5 to 5. I want to see something ridiculous like this, right? 53 times. Or I want to see a 4.5 times X. Or I want to see, obviously you see, when you see 136X, I wouldn't even touch that one, right? Because it's just way too volatile now, right? So, but that's in general like a good understanding on how unusual options activity is analyzed. But as I was mentioning earlier, you first need to understand, right, how institutions play the game, right? How do they play the game? Now, majority of you might think like how an institution trades, but let's kind of do a little exercise here and see if you know how institutions play the game, right? Now, be honest with yourself, because if you didn't know this before, I'm glad that I'm bringing this to light for you, right? So, institutions rarely take single-sided options, okay? The only market part, like the part of the market that takes single-sided options are retail traders, okay? Because there is an inherent market risk associated with trading naked options. What are the market risks? If you sell an option, right? If you sell an option, you open yourself up to unlimited losses if it's a naked option, just so you know, right? Because technically there is no end to how fast a stock price can drop, right? And that's something you have to be very careful about, right? And you can take on a lot of risk by not securing yourself. So I know that a lot of you that have tried your hand at the sell side of options, you get yourself into a mess because you don't understand this very important component that you can make losses too, right? So you tend to get yourself into a situation where you think you're getting yourself into the right bounce or rejection strategy, but then you end up putting yourself into a scenario where you hold on to the trade for too long, and then it broods losses more than 100%, right? And if that's happened to you before, say it's happened to me before in the comments. I really want to know how many of you actually have been through this. Not to call you out, but just to say that you have been battle hardened. Because you have been through that kind of a situation, you now understand what playing with fire in the options market feels like. And I think everybody who has traded options for a long period of time, they know this, okay? They know this. So I want to take the time to help you guys understand how the institutional playbook goes. And it really starts from either way of where you are, right? Either you could be here, or you could be here in a wave pattern or in a supply and demand structure, whatever stock or market you're in. This could even apply to commodities. This could apply to a variety of different things. So I want to tell you the strategy rather than apply it in a specific scenario. And let's assume that market makers have been pushing the price up of this, whatever ticker this is, maybe Sally's potato company, and they've pushed this price out of this resistance because potatoes have gone, the prices of potatoes have gone crazy, right? And right when institutions see market activity like this and they see, what is the word? Greed set in, right? Market makers and institutions are incentivized to participate in this activity. Majority of retail traders try to make money from here to here to here, right? And then what we do is we take profits, right? And what happens is retail traders get caught in either here, or here, making moves wrongly in either one of these sectors. Institutions don't play those games, right? Institutions play between here and here. That's as simple as their playbook gets, right? They provide liquidity when the market is fearful, plus liquidity here, right? When nobody wants to buy, they come in and buy. And then when the market is overheated and everybody wants to sell, right? They typically will sell way before everybody sells. So as liquidity is pumped into the system, all of these injections of cash. Who's taking this end of the trade, guys? You want to take a guess who's taking this end of the trade? The more expensive, all the way to the top here, while institutions are all out. Anybody know? Retail traders, right? Retail traders. So retail traders are the ones providing liquidity for any asset class to go up in value. Obviously, there's a handful of institutional traders here as well. And they push the price up. Right? In this spot here is where they typically sell calls, buy puts, and then once this is done next, then this is done. Gradually selling the equity off, right? So as the stock price comes down, then the value of the sold calls go to shit, the value of the bought puts go up, and the equity gains value. This is your holy trifecta in options trading, okay? Holy trifecta. So they make money not only on the put side, they use sells to pay for part of the puts, and then gradually sell the equity so that that cascading effect will enhance both of these positions, right? Does everybody understand that so far? So imagine you have a potential price structure that's breaking out here. I'm going to explain once again. Here is throughout this process, along the way, they are already selling their previous bought calls, right? And they are getting ready to exit their positions because those bought calls are now being sold to retail traders who think this is going to keep going and get higher. And obviously there'll be a few dumb people who will keep buying here and keep buying here and keep buying here, expecting that the market is not going to pull back in any whatsoever way. Not saying that the market will pull back, but my point being that institutions take advantage of this scenario, right? And you see it all the time. It repeats itself over and over and over again, right? That's what trading is about. It's about finding these moments and then playing these to the T like the institutions do, right? So then the stock price comes down and down and down and down and down and down, right? Down, 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 down. And then what happens here? As the price is coming down, everybody's buying what? They're buying puts, right? So what do? They go in the market and provide liquidity for puts. They sell puts, right? And then at the same time, they are planning to defend this area because they don't want the price to go below this area now that they have sold puts at that area, right? So what do? They go and buy calls, right? And the sold puts, whatever value they receive from here, it funds the bought calls. And once that is complete, so number one, number two, then they start to buy equity and send the whole thing up back into the other wave and the other side. And this happens over and over and over and over and over in every single market, every single part of the financial sector, right? This happens in the bond market, this happens everywhere, okay, everywhere. So, now that you understand this, you can start to paint the picture of how institutions trade unusual options, right? So, how are you guys doing so far? I'm gonna take a sip of water here, but I wanna check in with you guys and see how are you guys doing. Love it. We'll always remember this. Great. I'm glad that's helping out. All right, let's keep going. So what are the advantages and disadvantages of UOAs now? Now that's another big one, right? So first of all, let's go through the advantages, and then I'm going to cover the disadvantages. So one thing unusual options activity does for you is it gives you a broad understanding of where the dealer's exposure is, okay, in single stock options and indices. Individual stocks like Tesla or Nvidia or anything else that you were asking about. And then also on your SPY, QQQ, VOO, yada yada, right? You can really see where the dealer wants to buy and where the dealer wants to sell, okay? And what this allows you to also witness is when market participants are actively hedging, right? By default, SPY is very actively hedged, right? But what you need to understand in this circumstance is you can see options flow light up. It lights up very, very, obviously, I would say, very obviously, when market participants are about to hedge, okay? And when they are hedging, you can see that activity plays out in a bigger story or a time frame. So you will see UOA is a good way to kind of draw a bigger story or time frame, which can be surprisingly rewarding if you know exactly what you're looking for. And we're going to go through all those examples, right? Now, what about the disadvantages? Obviously, you can never be 100% certain of the reason behind each trade. This may cause you to develop that bias, okay? This is a very important part of what you need to avoid, guys, okay? And unusual options flow is typically abundant. There's a lot of it, and it's messy, and it's an overload of information, so you need to really be able to filter down, okay? You need to know what you are looking for, which we're going to go through next. The next thing is, smart money isn't always right. And many traders might ignore their own due diligence in the process and be tempted by the high percent return expectations. So let's talk about the anatomy of unusual options activity, because you need to know how to read it first, right, before you can start actually interpreting it. So in a general kind of flow information, you will be conveyed multiple things of data points. Okay, this is our own flow service that is part of our Discord, which has already been algorithmically dialed in to find the most actionable contracts that institutions are trading. I've built literally this algorithm on my own, right, to find the flow. So we have a service that provides us the data goes into a database. The database is obviously managed by an algorithm, and the algorithm sends us any things that match our scoring criteria. So the easy one is the ticker. Obviously, you'll see the ticker of the option, right? Google, for example, Microsoft here, Tesla here. Then you would see the type of option, right? Is it a sweep? Is it a split? Is it a block? Is it a dark pool, right? Then you'll see the expiry, how many days to expiry, right? It's really important to be able to know how many days you are to the expiry. And then you have the strike price of the options contract. You have obviously the strike at which the trader wants to have the price stay within or below or above, right, depending on the scenario. And you have the spot price. This is the price at which the stock, the options contract was bought, the price of the stock when the options contract was bought. So let's say when this contract was bought on Google, Google was trading at $130.58. So you can really pinpoint exactly when this contract was bought, right? Which is another piece of information which might be good for you. Next is total premium, right? So how much was put into this trade, and the contract price and the quantity. So how much of this, right? So let's say you see the open interest for this day is, let's say, 1,000, right? Let's just say the open interest for this day was 1,000. And then you see that the quantity traded in this trade alone is 6,000, right? You would be like, what the heck is going on, right? In Google. But you can see here the quantity for this trade is about the daily volume. So this is pretty significant still, right? And the same goes for these two here, right? Then you have something called volume and open interest, which are also important parts of it. So the open interest is right here, right? And you can see the day volume is right here, okay? We also like to add other things like the delta to give us a good idea of whether this options contract is worth it to buy. If you want to understand how options are priced, or whether you should or should not buy contracts or specific contracts, I highly recommend that you don't skip the beginner class that is about to come up, because I'm about to drop a new way of understanding that as well. We are constantly evaluating the way traders are learning, and I think that over a long period of time of doing this, it's a very interesting process to see that there are some concepts that work and some concepts that don't work. So the total volume with the options contract on the time of the day that the options order flow was sent is sent as the day volume, okay? And the amount of contracts that existed in the market heading into the current day of trading is open interest. So both of these are displayed below the premium and the contract price, as you can see, right? Okay. Now let's talk about sweeps versus splits versus block versus dark pools. Like, what the heck are all of these? These are the anatomy of the order flow, right? So you have to, I always like to say in EGA we use the peel the onion method, because you go through all these concepts first. You need to understand what you're working with. What's the blueprint of everything, right? What makes up this? What is the ingredients? And then you can start to interpret later, right? If you don't know what those things are, you don't know the ingredients, how are you going to make a dish, right? So same thing here. And so sweeps are your large orders, and they are across various exchanges, paying the market price. They are at the ask. Okay, so at the ask. Ask. That means I don't care what the price is. Give me this contract now, right? And it's considered very aggressive and directional. As you can see, these three are all sweeps, right? So somebody wanted to fill right away. Okay. Splits, on the other end, these are like sweeps, but splits are orders that are often broken down and executed into smaller orders. So only a single exchange, but they're not considered aggressive. Okay, they're usually going for the best price kind of structure. And blocks, these are large privately negotiated order executed by institutions, and these usually have financial backing. Now, your prime brokers, the ones that sit between the hedge fund and the market, are typically the ones that orchestrate your block trades, okay, because they have the custodial powers to do that. For those of you that have watched Billions, how many of you watched Billions, the series Billions? Anyone here watch the series Billions? If you have watched the series Billions, tell me right now. I want to know. Some of it? All of it? How many of you watch Billions? No? No way, that's crazy. Okay. Well, in Billions, it's a very good understanding of how prime brokers work, and the reason why I'm taking the time to slow down and explain block trades is because when block trades come out, you have to pay attention, okay? They are very much so negotiated on both ends. And the negotiation takes place not only on one side, it takes place for both parties. So they negotiate on what the agreed price for that contract should be. And usually the prime broker themselves provides the liquidity for the trade, which makes them incentivized for the trade to go through in the way that is beneficial to them. So this is the reason why we look at prime brokers as a very important part of trading. Okay. All right. Now, next one is dark pools. These are large single shares executed on a private exchange, not accessible to the public. But nowadays, all the flow softwares can tell you exactly what is traded within the day. Dark pools are a way for hedge funds and mutual funds to hide their trades for the first 72 hours of the purchase, because there are reporting requirements by the IRA for them to kind of report their trades. Okay. So what should you look out for when you are trading unusual options? This is the next one, right? The next thing. Now, unusual options, you want to definitely take your time to identify the quantity traded, right? So we want to identify orders that are odd numbered, first of all, because then it's a lower chance of being 1/2 of a spread, right? Let me move my camera because I realize that it is blocking you guys. So here's a quick, neat technique. You can always look at things that are odd numbered, right? If you have a trade go in that is odd numbered, that's an easy way to tell that it might not be part of a spread, right? Lower chances that it's a spread. Obviously, the other trade can be broken up and so on and so forth. But my point being, it's just easier for you to understand that. And then directional multi-hits of repeat flow that are relentless and all sweeps, right? This is a very easy one to immediately know. When something bogey is happening, something weird is happening. And then you dive deeper into those and you see what the open interest is like, for that specific ticker, so on and so forth. Then the next you want to look at the premium value. Are they putting all the money to work, right? We typically want to look for 500,000 or more in premiums on contracts that will expire urgently depending on the strike price. So it really boils down to a certain level of sensitivity to some degree. But in general, we want to see like less than 30-day expiry contracts that are above 500K within, maybe about 6% or 5% of the spot price that the stock was traded on, right? And we want to really see if this strike price, is at how many percent is it away from the spot price? Because that's an important factor, right? How far are they looking to get? For example, if you see an institution buy a super out the money contract that is unlikely to hit, something's going on there, right? Something is going on. Why? Because they wouldn't bet so far if they at least expect half a move to happen, right? And why do I say that? Because just the half a move would make gamma peak, right? And that's enough to add enough value to the contracts for them to get out, right? So understanding this very simple concept is really important. Now, when we see repeat flow, and the third part is obviously expiry and increasing OI, when we see repeat flow that is seeing increasing open interest in the shorter term contracts, while volume is high on the day, then it is less likely for that move to have happened. So these are three very key things you should look for. Now, I know many of you are thinking, why can't this guy just give me like a parameter? Like, why can't it just be like above 100K and then 7 days to expiry, right? And maybe, I don't know, 2 strikes away, right? Why can't I just have this as a threshold for my decision-making criteria? Can somebody answer this question for me? I would be very, very thoroughly impressed if somebody was following along and answered why you cannot box yourself in with a choice like that. So let's just say, I say, oh, if it is, within a certain means of a type of trade, like for example, a scalp, I'm looking at maybe 100,000 to 200,000. I'm just going to put an arbitrary value there and say that value is what I'm going to say as the max premium. I'll let you guys slowly answer. I know the stream is lagged by at least 30 seconds, right? Stocks are different sizes and market caps. Okay, that could be a good argument. But more importantly, I'm trying to make you guys understand that every trader's reason for taking a trade is different, right? Inherently, we all have a different reason for trading. Give you an example. Maybe somebody is looking at a scalp trade, but they realize that a certain contract is trading better because of the volume, right? So they take the trade and then they realize that because there's a lot of volume in this specific contract, like I want to scalp with this contract instead. But retail traders, when they read the flow, they interpret it as, oh no, somebody's taking a longer term hedge or somebody's taking a longer term contract. But they fail to understand that institutions don't really care about those concepts of premium in terms of liquidity. They don't care in terms of the delta positioning of that contract. All they're in there sometimes for is a quick buck, right? They're in there for a quick buck. They want gamma of the contract to rise so that they have enough exit liquidity to draw more people in, okay? They have exit liquidity to draw more people in. And this is really the important thing that you gotta have at the back of your head always. Whenever you're looking at a contract, you have to ask yourself, is it possible that that's the scenario? It's just like playing poker. What is the probability of this scenario, right? But of course, we are all gonna make mistakes. And the psychological challenges that come with unusual options activity is perhaps one of the worst, right? How many of you have taken contracts and then, the stock is still within trend, right? For example, let me give you an example. I wish my cursor was working. Here we go. Let's say you were trading a stock that was moving upwards, right? And then it's on a clear uptrend and it came down for that long-term trend line touch, right? And it kind of breaks below, and so now you get into shorts, but then the next day you get squeezed up, and only to find out that actually it ends up selling off anyway. These are all the offshoots of trading derivatives, right? Because it's a very volatile market and sometimes very, very difficult to predict. But what is it driven by? Three very simple emotions, right? Fear, greed, and clown. Okay? Many people say that there are two market emotions, fear and greed. I say there's a third one, it's called clown. And the clown only appears in derivative markets. You know why? Because the clown just thinks that everything is going to go his way without any problems, right? This is denial, for those of you that didn't figure it out, right? So fear and greed, these cause you to go through bouts of what we call loss aversion. Okay. For those of you that don't know what loss aversion is, you should definitely Google it and try to look up what loss aversion is. But because you take contracts in fear that you are going to not make the profit that you deserve, you take less profit, only to see the thing run. But then your greed turns you the other way completely when now you want to take additional risk on, and that additional risk on backfires on you, and you get yourself played between a paddle board of these two situations until you finally decide, you say, fuck it, I'm gonna gamble, right? So you move from these three stages consecutively, right? Back and forth. How many of you have been through this? Tell me honestly, okay? So how do you prevent this? The prevention is very simple. The same way you handle your equity and portfolio, which is in a structured, risk-managed style, you apply the same thing to your derivatives, right? But people tend to throw all of these rules out the window, right? They tend to throw all of them out the window when derivatives are involved. Now, this is where we come in, right, at EGA. Our job is to help you, to provide that kind of training and education mentorship program that is not just reliant on feeding you with signals, right? So we have a comprehensive one-on-one experience. You can sign up live with me for one-on-one coaching, live trading sessions which are included in our Discord subscription. But more importantly, I think the thing that really sets us apart is our live trading sessions. And obviously, I've just come back into the market quite recently, and everything is very accountable and transparent. That's the name of the game. It's very important to me to build a community that is built on sincerity and also on just transparency. So every week, all the trades that we take, which now I'm going to get back into because I just came back to trading, is start keeping a log of your entire trading journal with the team as you go through the week. Every single thing that we trade is called out together on the live voice, so that you can hear the risk management style, you can hear everything that goes into a trade, right? And I think that's something that you cannot fake, right? So I wanted to kind of take this time to announce that the EGA live classes are back. We have the beginner course and the technical analysis course that's going to be coming up. Here's the class schedule: Monday 10:30 to 11. Monday 10:30, which is 30th October to 11th. The November 3rd is going to be the beginner class, and then we're going to have 13 November to 18 November is the technical analysis course. These are now already live for enrollment on the website. You can go and check it out, learncompoundgrow.com. And this time around, you don't need any coupon code. I've already put the new prices up. You can go and see if it is something that you find value in. If there are past students in this chat right now, I think they can more than vouch for the beginner and the technical analysis course. And you can also take the bundle for a big discount as well. Okay, so there's really going to be a lot of opportunities for you guys to learn here. Now, if you're an alumni and you have taken the course before, you don't need to pay for it, right? You know that EGA courses are lifetime, so therefore you're going to get access to it pretty much if you ask for it. So you need to reach out to me and I'll add you to the mailing list, okay, after the verification. And here is going to be the price for beginner or technical analysis course. I've made it a bit easier this time around. I think that this structure works best for us, where we keep both the courses at the same price. So the TA or beginner course is going to be $388 this time around, and the bundle is $788, so you save a little bit of money. Plus, I'm throwing in 2 months of Discord access so that you can have that one-on-one access with me. Okay. Now, for those of you that want to hear from some of our students, so I think there are a few in the chat right here. So Pankit, hey, what's up, man? It's been a long time since I spoke to you. Nice to see you. Oh, by the way, guys, the live streams are going to be back too. Like everything's just going to come back right now, right? Because I was out for a while, but now I'm back. I'm slowly getting back into it, right? Oh, also, can I share with you guys something? It is kind of personal, but I'm going to share with you guys. Because I always share with you guys milestones in my life. I have always done that, right? But I'm going to get engaged in January, which is something nice as well. So yeah, I finally found the person who I want to marry, and that's going to happen in January. And then the wedding's going to be like probably at the end of the year next year. So I'll keep you guys in the loop about that. But yeah, I share things with you guys all the time, so I wanted to make sure that you guys know. I met somebody in my life and it's been going good. So yeah, appreciate it. Pankit, hey, great course till date, been years. Yeah, dude, thank you so much. Christina, agree, fantastic hands-on course, you won't regret it. Yep, yeah. So I mean, you guys can see for yourself. Like, I really don't need to blow my own horn. There are a whole bunch of testimonials here as well. I just wanted to highlight a few of them. Would love to be a part of it again and revise the content. It's always great to keep listening to you. Dustin says TA course was a game changer. Well, I'm really happy that you guys took the courses and enjoyed it. That's what we aim for, right? We really want to make sure that we get that value in. Thank you guys. I really appreciate it. Thank you. So this is one of our students as well. I'm just going to run through a couple of these. Honestly, I'm not down. Like you can also read it, of course. But Jairus here took our course like maybe in 2023 April, and he's been in Discord for a while, so he says it's a good spot to share my thoughts and experience. Been through the course, perfect for all levels of traders, right? It'll be the most ideal. You're looking for to kickstart your trading journey. Covers every aspect of things you need to know, or the things that you didn't know. Pay attention for your trading journey. If you're here and intend to sign up for the course, the bundle with the Discord would be super useful and of good value. So this is just a real testimony from our students, right? To emphasize on why it's good value, it's the short amount of time that's been here, the amount of information data shared within the channel is very useful information. Even if the data is slightly complex, T and the rest of the community breaks it down for you to understand. So he's talking about the Discord community. For those of you that don't know, we have 14 days free trial for our Discord. You can sign up anytime through the website. And here's another person, Jonathan Savage. He took the course in 2021. I've been toying with the idea of taking this course for a few months, and the only regret is I did not do it sooner. There's so much material out there, and even other courses, but not very many seem to be live and in real time with the current market conditions, which makes a huge difference, which is what I try to explain to you guys, right? And then here's the last one from APD saying, take the courses. I came across EGA last year, purchased the beginner's course, but did not fully grasp it because I was taking the biggest exam of my career. I've been through ups and downs with the market and decided to get back in the foundation and purchase the TA course recently. I rewatched both courses together and everything has clicked in place and made more sense. I truly appreciate the entire system because you can see everything he teaches be applied on a day-to-day basis. And so this is really important for those of you that have been searching out for that person who can mentor you. Let me be that person. For majority of people who have never had a mentor, reach out to me. I want to help you. If you are struggling, reach out to me. I feel very strongly for people who are struggling, and we will take it personal calls if needed, okay? So that concludes the webinar, but I'm gonna answer the questions now. Okay, so somebody said, let's see. I'm gonna go back up in this chat and see what I can get. Okay. Okay, so the first thing we were gonna talk about was gamma squeeze. Okay, so let's jump into a gamma squeeze. Now, which stock was the most famous for getting into a gamma squeeze? You guys know. The almighty, all famous GameStop, right? GameStop, this is the one. Now, what happens in the gamma squeeze is you have an abnormally large number of people that are short. They have to be synthetically short, okay? In other words, they have to be short the shares and potentially long options, okay? Or any kind of that combination of things, okay? And what happens here is, in that scenario, when there is a whole bunch of people that are short, they are prone to something we call a short squeeze. You guys know this one, I think, okay? Now, a short squeeze is the birth of a gamma squeeze, okay? Where it starts is a whole bunch of people are short, and a group of the market decide to call them out. And they start buying contracts, which are call options, okay? Now, when you buy call options, what happens? The dealer takes on your exposure, right? Your broker, whoever you're trading with, the Ameritrade, IBKR, Fidelity, Charles Schwab, I don't care what broker you're trading with. When you buy calls, the calls are on their book. They have to offload that risk somehow. So the dealer goes in the market by either going short 100 shares or by buying a put, okay? So now, as this thing gets more short and the dealer is forced to take on more negative exposure, the number of people buying calls starts to shoot up. If you have a scenario like GameStop where more than 1 million contracts were traded, right? It creates something called a gamma squeeze. This is when the calls keep forcing the dealers to go short and then squeezes more people who are short, which force these people to give up their contracts or give up their shares. When this liquidity becomes available, it creates a frenzy loop in which more people buy these call contracts, not allowing an exit for any of the short positions, okay? As this happens, the call side of the option chain bursts into action and the gamma of those options shoot through the roof. That is what a gamma squeeze is, okay? So that is the one time where buying call options collectively in a groupthink setting can cause the stock price to go up. That was what I was trying to explain to you guys earlier. Okay. Is that clear? Did anybody have any questions about the gamma squeeze? Excuse me. Okay. Let's see what else here. Okay, awesome. Okay, I think I covered all the questions. Does anybody have any more questions? I'm gonna give you guys like a minute more. If you have any questions, please post them. Where did the unusual charts come from? It's from our Discord. You can join the Discord community and you'll have access to the research reports that I put out. There's more than just this, obviously. We put out like institutional grade research reports from time to time, like for example this one on Microsoft that just came out from Goldman Sachs. And also, oh yes, I didn't announce this, which was a really prominent part of what I'm working on right now. For those of you that don't know, so we have created a new tool which will be a valuation Excel sheet which will give you the value of all stocks from a range and a variety of different information. And we're going to be spending, I'm going to be spending more time working on creating more watch lists in which stocks are undervalued or overvalued to give you a range in which you can buy them. So for example, this is the low range and this is the high range. And this will give you the valuation of stocks at all given moments. You'll know whether they are undervalued or overvalued. This is part of the premium service that we are kind of providing to Discord members. Like for example, I created another one for semis. So you can see in a snapshot, and I'll post these every week, where the valuations are. So everybody will know where the valuations of these stocks are every single week or every 2 weeks. Maybe every week is overkill, but we can decide, right? The other things that you will get access to are, for example, the prime broker reports giving us information on where hedge funds are putting their money, where the institutions are putting their money, and also the key unusual options activity highlighted every single day. What are the biggest bearish positions bought? What are the biggest bullish positions bought? And then we analyze the flow during real-time market when we are in the live broadcast right here. So that's kind of how the Discord looks like. I can give you guys a kind of an insight into it as well. We have a snipe list that we put out once a week. This I'm going to be more disciplined in doing right now since I'm back. And also, obviously, most of the trades are posted here. If I take a trade, they're all mostly posted here. So we have a variety of different types of tools and resources here. All charts are posted here for you to get feedback on. And of course, we have your earnings calendars that are posted here. We have bots that allow you to see the flow, so you don't need to pay for a separate flow subscription. Everything is here. And then you have dark pool access, so you have whatever that's bought in the dark pool, you can search it up here. The stock bot provides a ton of information. You can pull up anything from dark pool levels to, for example, econ stuff. If you want to just know what the econ calendar is, you can, for the next week, you can pull that up, and it'll give you exactly what's happening this week, for example. We have a classroom where you can ask questions, a place where you can confess for all of your sins, which I find is probably the best part of this Discord. And then the trade recaps and profits and losses where people post all of their gains and losses here. Not to mention an entire library of stuff, which is pretty insane. We have all kinds of books here. We have a day trading collection, a candlesticks collection, a long-term investing collection, an option trading collection, swing trading collection, technical analysis collection. All of these are books and articles and cheat sheets for you to learn from, resources that are endless in your journey for your trading, right? And then obviously all of the the videos that we have posted on YouTube are all here. So a ton of information to learn from. And yeah, so that's a good summary of our Discord. Question: sometimes call options premiums are more expensive than put options. Why is it? Why it happens in that scenario? So that in that scenario, basically what happens is you have higher volume traded on one side of the option chain, and that has a lot to do with something called implied volatility. Now, implied volatility is, I go through this very, very deeply in the beginner course. I highly recommend you take that course, because if I explain this concept to you right now and don't tie it together with everything else that you're going to learn a very sparse part of the options market. And I highly recommend that you learn it together with the other things. But in general, implied volatility refers to how expensive the chain is. It is a combination of both volume and open interest aggregated in a kind of a certain way. So the higher the IV, the more expensive. If institutions are trying to trade against other institutions versus retail traders, in what scenario does a hedge fund or institution lose to another institution or hedge fund? Is one institution or smarter than another one? Absolutely. Hedge funds, with the heavy exception of this past week, tend to always get squeezed. Think of this entire market as like a diasporic collection of buckets, right? Because you remember that it's all game theory, right? At the end of the day, you have capital that accumulates here, 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 right? And then expands it. And then capital accumulated here, here, expands it. Accumulated here, here, expands it, right? So as we come down, then the reverse thing happens. You have capital that accumulates here to sell it. Capital that accumulates here to sell it, right? So when you have these games that are being played on these smaller level waves, they're always going to involve one institution that's smarter than the other, because remember that trading is a zero-sum game. What does that mean? Only one person can win in every trade, right? So you want to be on the winning side of the trade. You don't want to be on the losing side of the trade. And in order to do that, you have to have information that's better. You have to have information that's better. You have to have analysis that's better. You have to have risk management that's better. That's the only way you make it as a profitable trader, right? All right. I hope I answered your question. Do option Greeks have seasonality? No, not really. I would say, I think the word you're looking for is not seasonality, but it's affected by credit markets. Credit activity will affect option markets. So to give you that same analysis back, it's remember that when interest rates go up and down, that affects the pricing of bonds, and then the bond pricing also affects options, because bond pricing is built into options. So for example, the 10-year yield might be a component that's built into a model, if that makes sense. But there's no seasonality. All right, I'll take any last questions here in a minute more. As far as information goes for the average retail trader, is Tradeetics good enough? I think so. I think so. But you'll be paying, you would be paying for just Tradeetics, which is, in my opinion, not a smart thing. Just to give you like the price comparison, right? I think how much is Tradeetics? Let me see actually. I know it's like pretty expensive. It's not exactly cheap. I'm just checking right now. Hold up. Pricing here. So, okay, so look. It's $69 for the individual. And then for Discord owners, it's $199 for a Discord server. Like, if I wanted to, I would just put Tradeetics on the Discord server that I have. But the problem with that is I find sometimes too much information is also disastrous. This is the reason why I prefer to analyze the flow on my own and then present it to the team, rather than have a scenario where we have just an endless stream of shit hitting us and we don't know what to make sense of the data, if that makes sense, right? So you need to have somebody who is there with you to try and explain to you what the data means. And to me, that's just worth more than signing up for the Tradeetics software and just using it. If IV is higher for call options, can we expect bid up, or it's opposite usually? That's a mixed situation. So let me try to explain this to you. So when a stock is trading like this in a very trend-defined manner, the IV will be very consistent and very normal. But when a stock explodes like this, right, this is when IV for call options will be higher. Because everybody's buying call options trying to get in on this. And then at some point, what happens? When the reversal happens, that IV, which was high, let's assume that it was 100% plus, right? It starts to crush, right? It starts to crush. As people exit the positions, it becomes less crowded and it tends to crush. It can go from 100% to 30% with just a very abrupt drop. So because the IV crushes, it's more sensitive to price destruction, and that can cause your premiums to deflate very heavily. Okay? It's the way an options contract is built. That's why you have to be very careful chasing trades to the upside, chasing trades to the downside. I hope I answered your question. What is your long bias and short bias for where the market can potentially go towards the end of the year? Okay, good question. I like it. So generally speaking, the time when we had our bullish call in our community was here. Okay, this is where I sent a newsletter out to everybody. I'm not sure who remembers if that newsletter about 8 months ago, about 6 to 8 months ago, where I mentioned that the bear market is over, right? And the bull market has just begun. And this was the moment that I spoke about that. So since then, we've had a considerable run, and now what we're experiencing is a very nominal pullback for us to run again, right? So how many percent does the average pullback on the S&P 500 go to? The maximum is 10%, okay? The maximum is 10%. So we go all the way down here is 10% roughly, right? And this is your previous area of supply, okay? This could be the potential area of demand if selling becomes more aggressive on this next wave down, okay? If. The other thing that can happen is this trend line, long-term trend line, is respected, right? So we are looking to accumulate positions somewhere between the 4150 to 4200 mark, okay? This is where you want to go long for the potential catapult and also liquidity event. Because we know that market makers, what will they do here? They will sell puts, they will buy calls, and then this whole thing will reverse and they will buy equity, right? Back up. Now, when will that happen? Very likely by, I would say, early next year. Probably, I would say by Q2 next year, we should be on our way bouncing a little bit, because the Fed would have already made a decision on whether they want to, cut rates or keep them steady for another quarter. We won't know until November, right? But in general, that's what I'm looking at currently. This is a very, I don't turn indicators on, but if I did turn them on, you would see majority of the volume profile is all in this area right here. This is literally the biggest volume traded in the next, sparse liquidity here. So coming down to 4200 is a no-brainer. But of course, if we defend very strongly at the 4300 here next week, that will also be something that I'll be looking for, a bounce opportunity here, right? And no, I don't use RSI. No, I don't use, all the rest of the indicators. They're all lagging. They don't matter to me. The only thing that I care about is price action, right? All right. That's all I have for you guys today. I hope that you guys have a great remaining rest of your day. For those of you that want to start enrolling into the course, you can. I've already made it live. And we will be taking enrollments all the way till October. Just so you know, attending this webinar does give you the edge of knowing that the prices on the courses are discounted all the way till we start the courses, okay? Once the courses are going to be started, the price is going to go back. So we're having a promotional offer right now. And I highly recommend that you guys join us. It's going to be pretty fun. And I really hope to see majority of you there. So till the next webinar, I will poll what topic you want me to cover for the next webinar, and we'll do another rundown of another topic in the market. But till then, I hope you guys have a great day. Thank you so much for stopping by. Smash that like button on the way out if you can. And yeah, I appreciate you guys taking the time out to be here. Have a great one, and we'll see you next time. Peace.